Okay, let's unpack this.
We are diving deep into something most people, they assume is just a simple transaction, a one-and-done purchase. Life insurance.
Exactly. You buy the policy, you pick a beneficiary, you set up the payments, and then, you tuck the paperwork away in a folder somewhere, and you just mentally label it, set it, and forget it.
But that couldn't be further from the truth.
Mhm.
I mean, the lifespan of that policy is often measured in decades.
And the journey of actually managing it is, well, it's far more complex than the initial application process ever was.
So today, our focus is entirely on that journey. We're skipping the sale part and focusing on the crucial ongoing service, the maintenance, the surprising adjustments, and the potential pitfalls that come with managing that policy throughout your life.
And the foundational insight here is so critical for you to remember. The agent's role doesn't just stop when the policy is issued. They are absolutely critical for what's called ongoing service.
Which really just means monitoring your financial and personal needs as they, evolve over all those years. And we know those needs are rarely static. It's an unavoidable fact of life. Your financial obligations, your family structure, it all changes.
Right.
So because of this, insurance professionals, they really should be scheduling periodic reviews with you. They need to determine if changes, and often they're significant ones, are warranted.
Because the coverage you bought 10 years ago might be, grossly insufficient today.
It absolutely could be. And this need for review is almost always driven by major life events.
Okay, so let's run through some of the high-impact ones. Number 1, new dependents. A baby, a stepchild, maybe an aging parent you're now responsible for.
Your insurance need immediately increases. You have to ensure your estate is large enough to provide for that person if you're not around.
Which usually means increasing your coverage, but it could also mean getting a policy on the new dependent's life, couldn't it?
It could. And what's fascinating here, if you already have what's called a family rider on an existing policy, it often automatically covers a newborn, usually about 14 to 15 days after the birth, without you having to do anything right away.
And then there's the big one, marriage. This has to prompt immediate action.
Oh, yes. Primarily changing the beneficiary to your new spouse, if that's what you want. And of course, if your spouse is financially dependent on you, well, that requires a whole new needs analysis.
To see if you need even more coverage.
Exactly. Now, let's look at the flip side, divorce. This is maybe the most dangerous and commonly overlooked trap in all of life insurance.
Okay, why?
When a divorce is finalized, it generally revokes an ex-spouse's entitlement under a will. But here is the massive catch. In most jurisdictions, divorce does not automatically revoke the beneficiary on a life insurance policy.
Hey, so if I got divorced 10 years ago and I totally forgot to update the policy I bought 15 years ago, my ex-spouse could
Legally receive the entire death benefit, yes.
even if I've remarried and have a new family.
Absolutely. The money goes directly to the named beneficiary on the form. The insurer pays out based on the paperwork they have on file, period.
That's a genuine horror story. I mean, imagining your current family losing out because you didn't check one box years and years ago.
It is a huge liability. Now, there's one crucial exception we should mention. The Civil Code of Quebec does nullify a pre-divorce beneficiary designation.
But for everyone else outside Quebec, you have to be proactive. You have to make that change yourself.
You must. And often, a divorce doesn't just create a risk. It creates a new requirement.
For support payments.
Correct. If your settlement agreement requires you to pay spousal or child support, it often mandates that you get life insurance specifically to secure those future payments.
And to protect the recipient, I assume there are special rules.
Yes. The agreement may even require the beneficiary designation to be irrevocable.
What does that mean exactly? Irrevocable.
It means you cannot change that beneficiary, you can't borrow against the policy's cash value, or even let the policy lapse without the consent of that person. It locks the benefit in place.
Okay, moving on from personal changes. What about work? We often overlook that, and I imagine an employment change is a huge trigger.
It's massive. Maybe you start a new job, and the group life insurance is just, not as generous as your old plan. You suddenly have a gap you need to fill with individual coverage.
Is there any opportunity hidden in that change?
There can be. When you leave a group plan, you often have the right to convert that group insurance to an individual policy without any new medical questions.
Really?
Yes, but usually only within a very short window, like 30 days. This can be a lifesaver if your health has declined since you first got that group coverage.
And sometimes the job change itself is actually a good thing for your policy, isn't it?
It can be. Say you move from a high-risk job, like manual labor, to a low-risk office job. That can result in a better lifestyle rating.
So you could actually ask for a lower premium.
You absolutely should. It can save you a lot of money over time.
Other big triggers have to be financial commitments. A new mortgage, for example.
Or acquiring a business.
Yeah.
Business ownership brings a whole list of specific needs. Funding a buy-sell agreement, securing a loan, covering a key employee whose loss would be devastating. The list goes on.
And finally, a big one these days, leaving Canada.
If you move abroad and you're no longer a Canadian resident, you must review your policy. Some contracts are only valid for Canadian residents, or they might exclude death in certain countries.
So after any of these events, the agent's job is to update the needs analysis and recommend changes.
Exactly. That could be simple administrative work like changing a beneficiary, or it could be major financial work like changing the coverage amount or converting a term policy to a permanent one.
That brings us to how you actually make a change. Amending a policy. I'm guessing not all changes are treated the same way by the insurer, right?
Not at all. We need to break them down into two categories. Administrative changes, which are easy, and then the substantial ones that require the insurance company to basically reevaluate you.
Let's start with the easy wins, the administrative stuff.
These are the procedural fixes that don't require new underwriting. So, changing a legal name after marriage, updating your mailing address, or, as we just discussed, altering beneficiary designations.
And for policies with cash value, like a universal life policy.
Adjusting your premium amount, changing how your money is invested, or just altering your payment frequency, those are all usually just administrative.
Because none of that really changes the risk for the insurer.
Precisely. But then you have the big ones, the changes that require new underwriting. These mean the insurer has to reassess the risk, and they might even ask for new medical evidence.
Like what, for example?
We're talking about adding another person to the contract or adding a special benefit, like a waiver of premium rider, and crucially, increasing your coverage amount. That always requires new underwriting.
Because you're asking them to take on a much bigger financial risk.
Exactly. But this is also where you can work the system to your advantage.
How so?
If your life has improved, you should absolutely tell the insurer. If you've quit smoking, for instance, or if your health status has gotten significantly better, maybe you lost a lot of weight or got a chronic condition under control.
So you can initiate a review to try and get lower rates.
You should. It could save you a fortune.
And I imagine if you're making big changes to a permanent policy, like a whole life or universal life plan, that also triggers a deep dive from the underwriters.
It does. Any change that materially affects the potential payout has to be reassessed. For instance, changing the type of death benefit, say, from a level amount to a level amount plus the account value, that alters the insurer's liability, and they need to reevaluate it.
Now let's move into what might be the most common and financially critical decision point for a lot of people. The renewal clock on a term policy hitting 0. Let's talk about the cost of loyalty. Renewing versus replacing.
Right. So term policies are designed to be renewable. It's a key feature, a safety net. It means they renew automatically at the end of the term, say 10 or 20 years, without you having to provide new evidence of your health.
The term stays the same, another 10 years, for example, but the premium gets recalculated based on your new age.
Correct. And when you first buy that policy, you get a schedule of guaranteed renewal rates. But here's where it gets really interesting.
Okay.
Those guaranteed renewal rates can be, and often are, substantially, dramatically higher than the rates on brand new policies for the exact same coverage.
Why? Why is that difference so huge? Why wouldn't they reward a loyal client?
It comes down to a concept called adverse selection. The insurer has no idea what your health is like at the moment of renewal.
And they can't ask because of the guaranteed renewal clause.
Exactly. So they have to assume the worst about the group of people who are renewing. They assume that the people whose health has declined, people who now have serious conditions, are the ones most likely to take that guaranteed rate.
Because they can't get coverage anywhere else. Meanwhile, the healthy people are out shopping around.
Precisely. So that guaranteed renewal rate has to be priced high enough to cover the higher risk of the people who must stay in that policy.
That pushes the cost up for everyone who just lets it renew automatically.
Let's use an example. Let's call him Kevin. He had a 10-year term policy. When it automatically renewed at age 45, the guaranteed rate on his schedule was $2,250 a year.
Okay, that sounds pretty steep.
It is. But because Kevin was still in good health, he applied for a brand new, medically underwritten policy on the open market. His new rate was only $770 a year.
Wow. That's a saving of almost $1,500 a year. Why would anyone stick with the old policy then if they're healthy?
They shouldn't. This is why you must shop around if you are still insurable.
But that huge savings has to come with some kind of trade-off. What's the risk in replacing the policy?
There is a very significant caveat you have to know about. A new policy saves you money, yes, but it restarts two crucial safety clauses, the incontestability clause and the suicide clause.
Both of which typically last for 2 years.
Correct. So if you get a new policy and die 18 months later, the insurer can investigate that claim much more thoroughly than they could have with your old policy.
So if they find any mistakes on your application, even innocent ones, they could contest or deny the claim.
That's the frightening reality. That 2-year window for them to challenge the policy details, it starts fresh every single time you replace a policy. And this high-stakes environment, where replacement can save you a ton of money but also carries this serious short-term risk, is why the ethics of replacement are so heavily regulated.
Right, because agents get paid a commission on new policies. That creates a huge inherent conflict of interest.
It does. An agent's fiduciary duty requires them to recommend replacement only if it is clearly and unequivocally in your best interest, looking at the whole picture.
The long-term savings versus the short-term risk.
Exactly. And when that duty is ignored, you get two specific illegal practices. The first is called churning.
What's that?
That's when an agent uses misrepresentations to convince you to replace an existing policy with a new one from the same company, just so they can generate a new commission.
And the other one?
It's called twisting. It's the same deceptive practice, but the old policy and the new policy are with different companies.
So to protect consumers from this, there's a special document, right?
There is. Most jurisdictions require you to receive and sign a life insurance replacement declaration, or LIRD for short.
And what does the LRD do?
The IRD is designed to make you stop and think. It forces you to answer critical questions before you cancel your old contract.
Like what?
Like, will the new policy pay the same benefits? Are the cash values or dividends going to be identical? Does the new policy have all the same riders and extra benefits that you're giving up on the old one?
It sounds like it's a checklist to make sure you know exactly what you're giving up and what you're getting.
It is. And the IRD must also come with a written explanation from the agent. This disclosure has to spell out exactly why the policy is being replaced, how the new one benefits you, and critically, it must explicitly mention those 2-year clauses we just talked about.
That clarity is so important, and there's one golden rule that governs this whole process.
There is, and it's non-negotiable. You must keep the existing policy in force, keep paying the premiums, until the new policy has been formally issued, delivered to you, and you've accepted it.
Because if you cancel the old one too soon and the new one is unexpectedly declined,
You could find yourself with no insurance at all.
let's wrap up by looking at the end of a policy's life, how it exits the books, either by ending the coverage or by transferring its rights. Let's distinguish between canceling and surrendering.
Okay, canceling usually refers to term insurance, where there's no cash value. You can just stop paying the premiums and let the policy lapse.
But for permanent policies,
For permanent policies with cash value, just stopping payments might not be enough. The insurer might just start taking the premiums from your cash value account, draining it. So written instruction is always best.
okay, so what is surrendering then?
Surrendering applies specifically to whole life or universal life policies with cash value. When you fully surrender a policy, you're formally giving up all your rights and the death benefit in exchange for that cash value.
But there's a middle ground, right?
There is. A partial surrender, this is where you just withdraw some of the cash value, you keep the policy, but the death benefit is usually reduced by the amount you took out.
And finally, what about policy assignments, transferring the rights to someone else?
Right. An absolute assignment is when you transfer everything, the legal title, all rights, all obligations. The original owner loses all control. It's like gifting or selling the entire contract.
And what's the more common type?
That would be a partial or collateral assignment. This is almost always used to secure a loan. The lender becomes the assignee, but not the owner.
So they can't control the whole policy.
But they can prevent you from doing things that would reduce their security, like taking out cash value while the loan is still active.
And if the insured person dies while that loan is outstanding,
The lender gets first dibs on the death benefit, but only up to the amount of the unpaid loan. The rest goes to your named beneficiary.
And if you default on the loan while you're still alive.
Then the lender can often force a surrender of the policy to get their money back.
And we noted a unique jurisdictional difference here in Canada for this.
We did. Outside of Quebec, this collateral assignment process is standard. In Quebec, for business debt, they require a specific instrument called a movable hypothec.
So what does this all mean? Our deep dive today, I think, confirms that life insurance requires vigilance, not complacency. Whether you're dealing with a huge life change like a divorce or just nearing a term renewal, active management is absolutely essential.
It really is.
And knowing the difference between something deceitful like churning and a smart beneficial replacement supported by that consumer-friendly LID document is key to protecting your financial interests.
And as we touched upon those complex movements of cash in permanent policies, whether it's accessing it through a surrender or transferring ownership entirely, it raises a major financial issue we haven't even discussed. Anytime cash value leaves a permanent policy in these ways, the tax authority views it as if you sold the policy. It's called a deemed disposition.
What does that mean for you?
It means the gain inside the policy, the money that grew tax-sheltered for years, could suddenly become taxable income for the person who made the transfer. It catches people completely by surprise.
So you think you're just moving an asset, but you actually just created a tax bill.
An unexpected tax liability, yes. And understanding the complex difference between how that's treated as pure income versus a capital gain in this specific context. Well, that's a deep dive for another day.